Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is Darden Restaurants, ticker DRI. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, this company has a market cap of $14.8 billion, enterprise value of $15.3 billion, so you only have about $500 million, $500 million in net debt. That's actually pretty low for a business in this industry, hotels, restaurants, and leisure. So we can see how that breaks down here. So Darden Restaurants owns and operates full-service restaurants in the United States and Canada. Restaurant industry tends to be fairly low quality. We'll see if that plays out here. They own 1,867 restaurants, including Olive Garden, Longhorn Steakhouse, Cheddar's Scratch Kitchen, Yard House, Capital Grill, Seasons 52, Bahama Breeze, Eddie V's Prime Steakhouse, Capital Burger, and 60 franchised restaurants under those various brands. So it gives you some idea of the brands that they have. Restaurants tend to be a fairly tough business. It's a very, very difficult business, very competitive. You can see that here with these gross profit margins of 21%, very low gross profit margins. So very competitive industry, tends to be lower quality or average businesses in this industry. We'll see if that plays out here below. Return on invested capital. What's interesting here is their numbers look a lot better than it would suggest for a competitive industry. You look at this and they maintain above 10% return on invested capital for many years of the last 20 years. They only have 1 year of losses in the last 20 years, which was, of course, 2020, COVID. So that's actually a really strong performance. I'd say 19 years of profitability out of the last 20 tends to suggest a higher quality company. So your return on invested capital numbers are looking actually pretty good. You do see cyclicality here. You're up and down, but I mean, on the low end, you're at 12%. On the high end, you're at 17% there. Then you bounce around a little bit. You do get to a low of 5% in 2014, but you spend only 2 years below the 10% mark before getting back up to 16%, rising to 22% in 2019 before the COVID impact. But it looks like they've recovered well from COVID and they're back up to 12-13% for 2022. These are actually pretty good numbers. Seems to be stronger than you would expect simply based on industry. So clearly they're doing something very well operating in their industry. Now, the return on median returns here, return on equity 24%, return on invested capital 12%. These are great numbers. I want to see return on equity above 15%. I want to see return on invested capital above 10%. So I'm actually surprised. This company appears to be much better and more high quality than I would expect for its industry. So it's just something to be aware of, that you can be surprised, that you can't judge something only on its industry. You need to look at the individual company results. And everything I'm seeing here says that it's at least above average and potentially high quality. The valuation also looks very reasonable. You have a PE of 16. 15, 16 is about average for an S&P 500 company. So when you're trading at a PE of 16, you're trading at an average price, but we've already determined this is an above average business. In addition, they're growing quite well. Revenue growth of 6%, high single digits, mid to high single digits. They're growing faster than assets, which is allowing them to have some operating leverage, and their EPS is growing at 7.5% a year. You think about this and you're getting an earnings yield of 5, 6, 7%. You're getting a growth of 6, 7%. You're in a good range for potential double-digit returns if you buy a company with this sort of setup, despite its being competitive. Now, you need to understand the competitive makeup. That's always a risk with restaurants, but they are actually priced at a reasonable level, potentially fair value, and they have some very nice, attractive, above-average characteristics. So looking good there. You can see that they had 2 years of revenue declines, which is basically the years of COVID, but otherwise they've grown very strongly. That's really nice to see. Other than COVID, you're seeing pretty strong, stable gross margins. Not strong, but stable gross margins, which is important. And then your operating margins are doing quite well as well. They have some increase in operating margins over time. You want to have some idea if that's sustainable. Now, again, some of this jump occurs starting in the 2017 range, where you get some impact of the tax cuts, which would have helped them significantly with their industry. But you can see some benefit there. Now, the stability on the EPS line is not super stable. That's what you see. It is jumping around a lot. You do have some really strong numbers here, but look, they've more than doubled their EPS over the course of the decade, despite having to go through COVID. They had $3.13 at the beginning of the decade. They have $7.39 at the end of the decade. They're trading reasonably based upon those prices, especially if you think you're going to more than double your earnings over the course of a decade, which is, again, what 7.5% means is every decade you should be doubling your earnings. That's a very strong setup. Likewise, their dividends are growing at a similar rate, $2, $4.40. They're sustaining this growth while paying out over half of their earnings. That's really impressive. That's a strong number to see for an investor, so you like to see that. Now, with that said, it looks like that's backloaded. They haven't been growing it very stably, so you need to get some idea of what's going on with their dividends because it's not super clear based on these simple characteristics here. But otherwise, the return on invested numbers look really good. Looks like a high-quality business so far and trading at a reasonable price. We're going to dive in more with the income statement. Before that, if you're enjoying this video so far, please hit that like button. Don't forget to subscribe and ring the bell so you can get notified as I upload new videos each and every week, Monday, Wednesday, Friday. And at the end of this video, I'll have a link to a playlist where I've already covered over 120 S&P 500 companies, so stay tuned for that as well. Now to the income statement. One thing that's really interesting here to me is their SG&A has actually gone down over the course of the decade. This is not normal. To see a company growing your gross profit by 50% but able to decrease their SG&A, that's relatively unique, and I think that's a big driver of their massive returns. It does suggest that it might not be repeatable. You're unlikely to see another case where you can drop your SG&A a third while growing your gross profit a third. And this biggest change occurred, of course, in 2020, 2021. So it looks like they cut a lot of costs during COVID to survive, and it clearly paid off well for them, but it's something to be aware of. You're not necessarily going to get that as a repeat. I would say this record shows that shares are basically flat. It has gone up a little bit, and then it went down a little bit, and then they've had to go up a little bit again. But otherwise, this is a very good number from the income statement in terms of managing their share count. PP&E is something I'm really interested in. Of course, it looks like they have grown it over time, decreased it over time. It's not been super clear what all is going on with these numbers. These numbers are just very unstable. There's not a lot I can say there. Long-term debt has gone down over the course of the decade. That's a really good sign. But of course, now they're incorporating capital leases because they're leasing the business. This is, again, part of that change in how you do business. So that can affect what you see in terms of your overall assets. That is, of course, also the driver that's probably taking place here is you're getting that added into PP&E, those leases. Overall, the balance sheet looks good. Cash flow statement. Let's see, net income. Again, 2020, you had a bad result. Part of that was this, you had these changes in taxes. You had all sorts of negative impacts due to COVID. So again, I'm not going to punish them for that. I like that stock-based compensation is both very low but easily offset by some buybacks over time. I like the stable share count. There is a big numbers being spent here, so it's something to be aware of and just look into. But otherwise, they're keeping debt low or reducing, and they're paying steady, growing dividends. So all of this looks really, really good. I'm impressed by Darden Restaurants. I did not expect to see this business go so good. When I saw the name Darden Restaurants, I immediately thought, hey, the restaurant industry tends to be quite poor. But this company looks like it's very well managed in a tough industry. They have strong chains. I've eaten at a number of these chains and enjoyed them, the ones that I've eaten at. So they have quite a lot of good brands there. Branding probably gives them some pricing power perhaps, and they might be a little bit more competitive over your typical mom and shop restaurant. That probably helps them. They would probably get strong returning customers. They have really good return on equity, return on invested capital, strong, reasonably priced, and stable and good growth over the 10-year period. So I like what I see here. I am unlikely to ever invest in a restaurant, so I won't invest in Darden, but I think, so it won't go on my watch list, but I've been very surprised with what I've seen, and if you're going to consider restaurants, then I think this is probably one worth looking at because they have good numbers. There is some, cyclicality, but that's just the restaurant business. But just thinking about how long they stay above 10% return on invested capital while operating in the restaurant industry, very impressive, very good growth. Glad I covered this one. If you enjoy this video, please hit that like button. Don't forget to subscribe. Ring that bell so you can get notified. I'm uploading videos Monday, Wednesday, and Friday. We're looking at stocks. We're going in depth on them. So I hope that is going to be helpful to you. If you enjoyed this content, if you want to study stocks yourself this way, get a business subscription, then you should use quickfs.net. So if you want to check out quickfs.net, please use my affiliate link in the description below. It is the first link in the description, so I hope you will check that out and do that. And if you do it through my description, you sign up for either a free or a paid account, then I can get a commission by sending you to their products. But this is the product I use each and every day to study stocks. This is what I look at. This helps me to make quick 5-10 minute decisions on investments. So I find it very helpful, and I wouldn't recommend anything that I don't use myself. So thank you for listening, and until next time, stop paying fees, start building wealth.